how to trade yield curve inversions. We have been inverted now here in the U.S. in our yield curve for, I think, about a year or so. And you can see this is 30 years of data, bringing you so much data here on this show. In the last 30 years, we actually haven't been as inverted as we were just a couple of weeks ago. The biggest inversion that we saw since the early 80s, actually. And the trend that we've been on in the last 2 years, as we start at the present on this brief history, has been almost a straight shot from the end of 2020 being the yield curve being structured so that there's about a 1.5% difference between the 2-year and the 10-year interest rate. That's the main barometer for how the yield curve is structured, is the difference between short-term and long-term interest rates, and we usually look at the 2-year and 10-year. And back in 2020, the difference between the 2-year and 10-year interest rate was 1.5% to the upside, meaning that 10-year interest rates were a full 1.5 higher than 2 years. That's normal. If I'm going to loan out some of my money to a friend, to a business, to whoever for more time, I would naturally demand a higher interest rate. If I'm only willing to lock up my money for a year or two, then I'm usually only going to get a lower interest rate there, a normal yield curve, and obviously vice versa. If I'm taking out loans and I need more time to pay it back, I'm going to usually have to pay a higher interest rate. If I'm able to pay my loan, my mortgage, whatever, back in just a couple of years, it's going to be a lower interest rate. Now, where have we been for the last year? We've been in negative territory here in the difference between long-term and short-term interest rates. Not only have we been negative, my friends, but we got all the way down to negative 100 basis points, a full point of difference between, and we were talking about this on the show. This was just a few weeks ago, where we had passed for just a day or two a percentage point of inversion, and that snapped right back. And it snapped back mostly because the banking crisis and other things brought fear in the market, that is, brought short-term interest rates much lower, with the idea that the Fed might have to cut interest rates if that crisis was bigger than posed just in the first few days. But we still are in negative territory here with an inverted yield curve historically. We've only seen this inverted yield curve right before some of the biggest crashes in history. And I don't want to get into this today. I want to more get into how to trade interest rate spreads and this inversion that we're still sitting at. But a lot of macroeconomists and book learning types will usually point out this correlation between yield curve inversion and stock market crashes. And the correlation is there. Is the causation there? I'm not so sure. You will see that we have blipped into inversion territory a few other times outside of right before the dot-com crash and right before the financial crisis. There we saw these blips in the early 90s, the mid to late 90s. There, just a few years ago, there was an inversion blip, and we just went right back into normal territory. And the stock market, obviously, momentary crash during the pandemic there, but the stock market ended up closing around all-time highs there in 2020. So that inversion, and that's actually a great example there of how you can't, an inverted yield curve is a signal that, the economy is fluctuating. It's maybe changing cycles, so to speak, from a time of great economic growth to a slowing period. And sometimes that slowing period can translate in a crash as it did in the early aughts and in 07, 08, and 09 there. But other times, like I would use that example of prior to the pandemic as an example of the fact that inversion doesn't have to necessitate a stock market crash, even though the stock market did crash in the early part of 2020. How in the world could the yield curve have foreseen a pandemic? It just couldn't happen that the interest rates in the U.S. are predicting a pandemic in the mid part of 2019, early 2019, as that yield curve got closer and closer and then inverted there in 2019. It is, though, what was happening in 2017, 18, and 19 as that curve trends lower and lower and then finally inverts for a couple of days. What was happening in those years is the stock market was seeing extreme growth and short-term interest rates were starting to be hiked by the Fed. And it was, like I say, changing cycle from extreme growth to a little bit slower period, which I think we're solidly in now. And as that was occurring, we saw this yield curve inversion, like I say, kind of a shifting of the cycle that doesn't necessitate a crash, but if handled poorly and a couple other things happen, then a crash can occur. So we'll see. Jury's still out if a stock market crash is coming. But like I say, I don't want to spend too much time on that correlation, although I've already spent now 5 minutes on that. Let's get down to the nitty-gritty of trading the yield curve and its current inversion. Like I was saying, we're talking about the 10-year versus the 2-year here in the U.S., U.S. Treasury yields. And we're still at around 50 basis points of inversion. That's negative 0.5%, negative 50 basis points. But we have normalized more than 50 basis points just in the last few weeks. You can go back and find the segment that we did in the first or second week of March there, where the inversion was down below a full percentage point for, it was just a trading day or two. And we've normalized very quickly 50 basis points. And now we're 50 basis points away from a normal curve, which would be in positive territory. And this is still quite the extreme. I mean, you go back to my longer term chart, and 50 basis points of inversion is the most inverted that we've been in the last 30 years plus. And we're still there. We're not at the low, so to speak. We could get back down to those lows, but we are still at a historical extreme. And so what would this mean then? Because these are two different markets. Remember, this is the 10-year and the 2-year interest rate. And it's like, oh, okay, I have, futures at my disposal that track the 10-year and 2-year interest rate. And I've got futures at my disposal that track the inverse of interest rates. I know a lot of inverse and inversions here today, which is the 2-year and 10-year Treasury notes, ZT and ZN futures. So what am I meant to do? How do I trade these two things? I would have to trade them in a pair. So I would need to be doing two things at once that are counteracting each other. I'm buying one thing, selling another with an intended outcome. Well, these have cool names, these two intended outcomes, which is steepening and flattening. Yield curve spreads are the differences between interest rates, and there are two spreads, and that is the steepener and the flattener. In the steepener, I am going to be short-term interest rates and long-term interest rates. Of course, this is going to be difficult if I don't have the right verbiage out there, but the furthest right column is meant to be long-term rates there. I'm sorry. In the steepener, what you want is interest rates to expand versus each other. So in this scenario, you would want the spread between the 10-year, the long-term interest rate, and the 2-year, the short-term interest rate, to gain ground, that spread to get higher there, whereby the 10-year rate is building a higher interest rate than the 2-year, thus steepening of the curve, whereby you have the 2-year plotted here, the 10-year plotted here. If the 10-year starts to get higher than the 2-year in interest rate, my curve is now steepening, whereas if it was coming down to meet the 2-year, now I've got a flat curve, and that is so named for the other way. If I'm long short-term interest rates and I'm short long-term interest rates, then I want that yield curve to become flatter. I want short-term rates to be on the level with long-term rates, or they can get inverted like we are now, where short-term rates are higher than long-term rates. So those are the two types of spread here in the yield curve. And so with our current environment, where we have flattened so much to be inverted, if I wanted to buy this 10-year, 2-year spread with the idea that it's going to normalize to positive territory, that would be, I would be buying the 10-year, 2-year spread. I would be putting on a steepener. The yield curve, I'm hoping to steepen, to normalize there. If I thought it was going to get more inverted, I would put on a flattener, whereby I would be selling the 10-year rate and buying the 2-year rate, hoping that this inversion continues even further. And that makes sense, right? Like essentially, if you want to use the nomenclature steepener and flattener, it is some cool words to use, and in the long run, it will help you to understand the concepts a little bit more. But in the short term, just think about what you want to happen. This is what I always tell people when they're thinking about pairs trading. If you're pairs trading Coke against Pepsi, if you think Coke is going to do better than Pepsi, then you buy Coke and you sell Pepsi. That's the pairs trade there. Same with the current yield curve. It's inverted. Do you think it's going to get less inverted? It's going to normalize? Then what do you need to do? Well, you need to be long those long-term interest rates that are now less than short-term interest rates and sell the short-term interest rate there. Do I think that the curve is going to get more inverted, that there's going to be more craziness to come? Then what do I need to do? Well, I need to sell the long-term interest rate, and I need to buy the short-term interest rate on them getting even more inverted there. So you can always understand the concepts, but you can whittle it down to just what do I think is going to happen, and then go do that in the market. Other ways that you can view it here with that same chart that we were looking at to start the show, which is the same thing, the 10-year versus the 2-year over the last several decades. The rising and falling of the spreads correlate to steepening and flattening, respectively. As the 10-year gets to 2%, 3% worth of difference over the 2-year, that is steepening. As it falls down to being only 50 basis points, 100 basis points on top of the 2-year, no difference between the 2-year, that is flattening on the way down. And you can see a lot of mean reversion here, a lot of oscillation around what's been an average difference of about 1 to 1.5% between the 10-year and 2-year. And obviously we're at the extreme to the downside. Another way to view it is the diverging or converging of rates. Looking at the individual rates here, you have in the blue the 10-year, and in the orange the 2-year, and you can see that, okay, at the start they're widening out. That 2-year is falling faster than the 10-year. The orange line is falling faster than the blue line, and thus there's steepening, there's diverging of the rates. And then right as you go from left to right, you see that the blue line and orange line are both bouncing back. They're both moving higher in the mid-90s, but that orange line comes all the way up to meet the blue line, converging. There you have flattening. There you have the difference between these yields getting near to zero. And you can keep your eyes on that mid-90s area where we go from there being a significant difference between the blue and the orange to them coming together in about 1995, 1996 with the spread right there correlating to a big difference, a high value in the spread here down to almost zero as they converge. So a bunch of different ways to view the flattener and the steepener, the converging, the diverging, the falling and rising of spreads. At the end of the day, if you want to trade them, just try to dumb it down to, what do I want to get done here in the market? Do I want the interest rate, the yield curve to normalize? Well, then I need to get long-term interest rates and short-term interest rates. Do I want more inversion? I think there's more inversion to be had. Then I need to get long short-term interest rates and short long-term interest rates. A lot of heavy concepts here today on the yield curve inversion, but there is pretty much all you need to know about getting started trading the yield curve and its current inversion.